Okay. Good morning, everybody. Thank you for taking some time out of your day today to join us for our April webinar. This is part of our monthly webinar series that we do. We do this as part of our service to your company's 401k plan. Our firm, 40W Advisors, has the privilege to serve as the retirement plan consultants on your company's 401k plan. And as part of that, we want to just provide some education and information to you to make you a more informed retirement investor. And that's really what the 401k is all about. It's about saving money and letting that money grow through investments for your future. So before we get started, I'll just throw out a couple administrative items. First off, everybody's currently joined in listen-only mode. So if you do have any questions, please use the questions box or the chat box that are on the meeting control panel. I'm working off of one screen today. I'm traveling, and therefore I'm going to try to keep an eye on the questions as they come in. We'll try to answer them in real time, or we'll answer them at the end. The next administrative item is from a compliance standpoint. Everything we talk about today is just for information and educational purposes only. Nothing should be construed to be any personal financial advice for your specific situation. We'll connect you with some tools and things at the end that will allow you to dive deeper into your specific situation. And I would encourage you to reach out to us if you're interested in just talking one-on-one. And we can have those conversations as well. So with that out of the way, let me just kind of further introduce myself. My name is Chris Thomas. Hello, if you haven't joined us before. And I'm joined by my colleague, Micah Potashnik. Hello, Micah.
How you doing, Chris?
Very good. Micah and I are going to kind of tag team this throughout. And as you saw probably from the title slide there, today we're going to talk about the investment markets. And yeah, a lot's happened over the last 3 months. So just so you know, every quarter, at the end of every quarter, we dive in to do a market review, and then we try to couch the market review with just some investor education, just to help you kind of understand what's happening and how you might want to think about it as a long-term investor. So a lot's happened. So I imagine that people have a lot of questions, maybe a lot of feelings about what's happening in the stock market right now. So what I'm going to do is I'm going to start off with just a poll question because I'm interested. I want to see what how everyone's thinking out there. So this first poll question is just, how confident do you feel about your 401k investment sitting here today? And I'll give you a few minutes to answer them. All right, see a few more coming in. All right, I'm going to go ahead and close this poll. Let's take a look at the results. Looks like we've got, about half the people are worried, which I think is a pretty common feeling right now with everything that's gone on. We'll talk about. And then we've got 30% that are confident. So that's good. That's it's a good sign. And if you're confident after the last couple months that we've seen here, that probably means that you've spent some time thinking about how you're invested and you understand the time horizon for which you're investing your 401k money. So let me go ahead and hide this, and then let's get into it. We're going to start by looking at market performance, what's happened. We'll talk about where we might go from here, and then talk about some historical periods in the market similar to what we've experienced recently. So just looking at what happened, look, we do these typically on a quarter basis, right? So we look at, a lot of times we're measuring what happened in the stock market or in the investment markets through the end of the quarter, which would have been March 31st. Well, April 2nd, as we'll see in a minute, was Liberation Day. And that's the day that a lot of, the tariff announcements, came out, and the market reacted pretty aggressively to the downside. And we'll take a look at that. So just to make this contextualize this a little bit more, here's what you're looking at. and you see what the returns were through the end of March. And then if we just extended them out an extra, a little over a week, you can see the returns were much more negative. And the biggest losers over this period have been U.S. stocks, frankly, which has not been the case for a long time. When the markets were climbing, what we saw was that U.S. stocks were outperforming everything, and international stocks were lagging behind. So what we've seen so far year to date is we've seen a little bit of the opposite. So you can see, U.S. stocks, large U.S. stocks measured by the S&P 500, down a little over 4% on the quarter and down, close to 9% through April 11th. And then small cap stocks got hit even harder. So this is smaller companies domiciled in the U.S., down almost 10%, 9.5% on the quarter, and then down 16%. International stocks positive. And we're looking at both international stocks on the developed front being the best performers, positive for the quarter and also positive through April 11th. Emerging market stocks were positive on the quarter and dipped negative. Bonds, which tend to be the more conservative allocation to one's portfolio, have held up, and they've done what they were really supposed to do, especially during the first quarter. As you can see, bonds were positive when stocks are negative, and that's one of the reasons why we include bonds in portfolios, and we'll talk more about that. On the right-hand side here, I show you the using some indexes. These are the Morningstar target date fund indexes. So this is just kind of a proxy for what different target date funds might have done during the quarter and through April 11th. And as you can see, the more conservative target date funds, so those would be the ones with a target date closer to a shorter time horizon. So this 2030 fund is for those who might be retiring in the next 5 years. You can see those were even, pretty much flat on the quarter and slightly negative, whereas the more aggressive target date funds saw a little bit more downside with the rest of the market. So before I turn it over to Micah and have you jump in here, Micah, let me just kind of do something I do every quarter in these presentations, and that's just to remind you what a target date fund is and how they work. Target date funds are professionally managed portfolios that are created based upon your time horizon, and that's specifically your time horizon to retirement. And we're usually looking at targeting your age 65 or age 67 for your target date year. So those who are more aggressive, those are the longer time horizon, are going to have a more aggressive allocation. So you can see a 2060 target date fund likely has about 95% of that portfolio allocated to stocks. Stocks fluctuate more in the short term, but have traditionally generated higher returns over a longer period of time. So those with the longest time horizon are going to have a higher allocation to stocks. As you get closer to your retirement year, these target date funds automatically adjust the allocation to start to introduce more of the conservative piece of the portfolio, which is bonds. So you can see a 2045 portfolio, now you've got about 90% in stocks, 10% in bonds. And then that 2030 portfolio that I mentioned before, you've probably got about 40% in bonds and 60% in stocks. With target date funds, you don't need to worry about changing your investment as you get closer to your target date, to your retirement year. The funds will automatically evolve and get more conservative as we go. So with that out of the way, let's take a closer look at kind of what happened over the kind of the wild last month and a half or so. So Micah, I don't know, I'll let you jump in here. Maybe you want to take us on this journey.
Yeah.
What we've seen.
Yeah. So as Chris mentioned, it's certainly been a volatile start to 2025. The first sort of 6 weeks of the year leading up to right around middle of February was sort of a similar to what we saw in 2024 and 2023, where stocks across the board. So we have 4 different colors on the screen here. We have a purple, which is the S&P 500. So that represents the large cap universe, the top 500 companies in the US. We have the orange line, which represents those non-US stocks. So Chris talked about how international non-US stock performed very, very well relative to US. We have the blue line, which is the Russell 2000. Those are what we consider the small cap universe, or the smallest 2000 stocks in the US. And then we have the green line, which is the bond market. So that's the ballast of the portfolio, that complementary piece that should hopefully offset some of that market volatility. So again, those first 6 weeks of the year started off similar to what we saw the last 2 years, where things were slowly kind of grinding higher. Always going to be a little bit of volatility, but you can see, right around that first black bar and the line bar on the screen, right around February 13th, everything was still positive for the year. And that's when President Trump, signed the memorandum on reciprocal tariffs, announced 25% tariffs on autos, and around that same time, we started to see some, just natural declines in the economy with retail sales. The consumer is a huge driver on GDP growth, so anytime you see the consumer potentially pulling back spending, that's a little bit of a sign for concern. So right around that date is when you sort of saw things kind of flip 180, and the equity markets across the board, especially here in the US, started to decline. March 3rd came around, and that's when more 25% tariffs were announced on Mexico and Canada, and you saw a continued decline throughout the remaining month of March. What we'd like to see, though, is that green bar. So that green line, sort of kind of in the middle of the screen here, that's the bond market. That's provided that steadiness. You can see that despite the other lines moving up and down in both directions, that green line has stayed relatively steady and positive. Again, those are the bonds, that fixed income, that ballast. And so even though we've seen significant volatility in the equity markets, the bonds provided that complement throughout the year so far. Fast forward to April 2nd, Liberation Day, when more reciprocal tariffs were announced. And as Chris alluded to, that's when we saw a very significant decline in the markets. And we saw the US equity markets decline over 10% in just 3 trading days. It was some volatility that is very, very rare. And for about a week here, things were teetering on, not necessarily a financial collapse, but approaching, bear market territory for the large cap stocks. Small cap stocks entered bear market territory, meaning they were down over 20%. And at that point in time, even the bond market started to decline some. And so right around April 9th, about a week after the original reciprocal tariffs were announced, there was a 90-day pause across the board outside of China. And last Wednesday, we saw the S&P 500 return about 9.5%, which was the 3rd best day ever. So even with that increase, everything is still down for the year. Certainly things have steadied relative to where we were about, a week or so ago. But, certainly, given the uncertainty across the markets, which we'll talk more about, there could be some significant continued volatility throughout the remaining part of not just this quarter, but probably the rest of the year. So Chris, I'll let you jump in here and add to that.
Just a couple points to highlight there. One is, as Mike has said, the investment markets do not like uncertainty. Investment markets are driven based upon what analysts and investors in general think about the performance of the companies they're investing in, the earnings that they're going to generate in the future. So when uncertainty comes in about the economy, meaning people aren't spending, these companies aren't generating as much revenue, that's a problem. Or tariffs. We're going to talk more about tariffs, just talk about fundamentally what tariffs are and how they impact companies and markets and consumers here in a minute. But that's uncertainty has been the name of the game so far. And as you can see, things move dramatically. And that's the other thing I want to point out here, is that things move dramatically during news flows and just right now. Any sort of headline, any sort of announcement is causing the markets to move, and it's causing them to move quickly. That's why it's very important to stay invested rather than trying to time when you get in, when you get out. If you look at April 9th on the far right side here, you can see that things were bad, and they were moving down pretty quickly leading up to April 9th. We wake up April 9th, a few hours into the day, and the administration announces that they're going to put a pause on the 90-day pause on the tariffs. And what we saw was that one day we saw a sharp market correction. We saw the S&P 500 we saw it jump 9.5%, as noted, the third best day ever for a 1-year return. So if you were sitting out, if you've gotten scared, moved your money out of the markets prior to April 9th, you would have missed that very sharp and very meaningful correction to help bring your account values back up. So I just wanted to point that out. And what I really think that most people are reacting to right now is, when we asked the poll question, we saw about half the people are worried. It's really been that dramatic move down that started February 19th, went through April 8th. We saw U.S. large cap stocks fall about 19% during that period of time. Was that about a little less than 2 months? And then it mentioned small cap stocks, U.S. small cap stocks down 23% during that time, and international stocks down 10%. So you saw portfolios, particularly more aggressive portfolios that were more heavily weighted into stocks. You saw a sharp decline during that, which only naturally causes some emotional turmoil and some concern. And that's why we want to jump in here, and we hope that you come out of this feeling a little bit better. You see the note, you see the bear on the screen here. That's just in reference to what you hear about. You hear about bear and bull markets. Well, technically a bear market is when a market drops 20% from its high. So as you can see, the S&P 500 stopped just short of what would be a technically called a bear market. But you may hear us reference that, throughout the call today. So just wanted to kind of explain what a bear market is, just because you hear about it in media as well. So that's where we are. Let's kind of just take a step back and let's talk about where we might go from here. And with that, let's just, the name of the game right now is tariffs. So, Mike, you want to kind of talk us through this and just kind of, what tariffs are and how the administration's planning on using them?
Absolutely. So again, a tariff is a tax charged on goods coming in or out of a country. So if there's a tariff charged on a country for imported goods, that means the cost of importing goes up, and that the idea behind that means it keeps companies maybe saying, I'm better off creating goods and producing goods here in the U.S. versus abroad. That's sort of the high level of why these tariffs potentially are part of the reason why this administration is looking to add tariffs across the board. So again, goals of the administration. One is to reduce the trade deficit. Again, right now, if you're importing more goods than you're exporting, that's considered a deficit. And so by making it harder to import due to increased costs, that theoretically should lower the trade deficit. So that's one of the main reasons why this administration is looking to increase tariffs. Again, it discourages foreign goods, and again encourages domestic production across the board. Next you see is that there's reviving American manufacturing. In that same vein, tariffs are designed to protect U.S. industries. So you see a lot of whether it's steel, auto, semiconductor space, all this AI creation. A lot of that comes from cheaper foreign production. And so by having tariffs, hopefully that will force companies to potentially reopen U.S. factories, create more jobs here in the U.S., invest in domestic supply chains across the board. Also, there's to strengthen national security, promote sort of this economic nationalism, be more self-sufficient here in the U.S., less reliant on other countries, as well as you can see force trading partners to make concessions across the board. This administration has signaled that tariffs will remain intact until countries agree to new deals that in their mind is more reciprocal. We have, again, this reciprocal tariffs, making sure that the playing field's level. We could argue back and forth of what's considered fair, unfair about these reciprocal tariffs, but again, that's what the administration has in mind, to keep an even playing field. And then the final two is to sort of reset the global norms. This whole America first, making sure that these potential multilateral trade agreements that have happened in the past, this administration feels that's put the U.S. at a disadvantage, and so making sure the game changes from that perspective. And then last but not least, sort of a political messaging. Again, the theme is sort of bringing jobs back to America, America first, across the board. So high level, that's sort of the idea behind tariffs. As you've seen here, the markets have not been too happy with tariffs because trade war historically is not a good thing. Free trade is something that enables companies to keep profits as high as possible, keep profit margins, keep costs low, and anything that has higher costs and those costs get passed on to you as the consumer potentially creates issues. So that's very high level of what's been going on and why the markets have been reacting so negatively across the board on tariffs.
Yeah, and I think just to point out there too, I think with the 90-day pause in the tariffs happened last week or April 9th, the one country that didn't have the tariffs suspended was China. And so the administration sees China as a threat, and that's why the national security piece is one. If we are, from the administration standpoint, if we are reliant upon getting critical chips, as Micah mentioned, that we need for building up our weapon systems and just our overall IT infrastructure throughout the country, if we're dependent on other countries to provide those chips to us, we can be cut off at any point in time. Therefore, them kind of, blockading us from developing those technologies. Same thing with drugs, with medications and drugs. One thing we saw during COVID is that, if we needed to get a massive amount of drugs needed to be imported here, well, the rest of the world was also looking for those. So if we're relying on other countries to provide those to us, again, they could cut those off at any time. So there's an economic, a political, and a national security rationale for tariffs, that plenty of economists have lobbied for. Now, whether or not they're being carried out in the way that those economists would, support, I think that's another question. What we saw, so we just mentioned that, we had, from the administration standpoint, the U.S. was being assessed tariffs by other countries when we were exporting stuff to them, but we weren't assessing a tariff on our own when people were importing to us. Therefore, they saw us at a disadvantage. So on Liberation Day, that April 2nd, when the tariffs were announced, those tariff rates that are, again, now under that 90 days suspension, represented the highest tariff rate going back to 1909. So that's why the market sold off so quickly on April 9th. It was because what the administration announced was far more aggressive than what anybody had really predicted. And I'll just handle this one too, Micah, here, talking about just more about the administration and their strategy. Well, here's what it looks like might be the strategy, right? They have one thing they did do and is still in place is on the bottom here, and that's a 10% universal tariff. So that's 10% tariff across the board on everything coming into the United States. That's still in place. That is a way that the administration is looking at raising some additional revenue, bringing more money into the country because those tariffs hit the U.S. balance sheet as if same place tax revenue goes. It's money coming into the United States that can be used to pay for defense, Medicare, Social Security, all. The next level up were the reciprocal tariffs, and those were the reciprocal tariffs that were announced on April 2nd and then are currently postponed. Those reciprocal tariffs, again, were a way to maybe try to bring in some additional revenue, but they were also what it seems to be is a retaliatory measure to try to bring other countries to renegotiate the current trade agreements that we have with them. And that's why the reciprocal tariffs were so extreme, because they really needed to kind of shake people up, bring them to the table to negotiate. There's other tariffs that are in place right now that on specific sectors, 25% on steel and aluminum, autos, and there's some in the semiconductors and pharmaceutical space. So this is a place that we're looking at just protecting our local industries by assessing a tariff when they're coming out. So just a kind of a way to think about, and I guess the top line here is policy-based, and that's looking at the tariffs as a way to influence other countries to step up immigration, help with the, controlling fentanyl and and the crossing borders of lethal narcotics. So this is the approach that it seems like they've been taking, and just wanted to give you kind of that backdrop. So, Micah, we talked about, what kind of the administration's objectives are. You mentioned markets don't like tariffs. Tell us why.
Yeah. So number one is higher consumer prices. Again, if it's costing more for companies to produce goods, they're going to generally pass those goods, those costs on to the consumer. And therefore, that creates two things. One, a slowing economy because things cost more. Therefore, consumers are not purchasing the same amount of goods. And therefore, companies' earnings get hit at the same time. And so that's why sometimes you hear a term in the industry going around right now is stagflation, a combination where economic growth is slowing at the same time inflation is rising. So that's ultimately what the markets do not want to see. And that's why, without getting too much into the weeds of the Federal Reserve, that's why the Federal Reserve and interest rate policy becomes so important in the grand scheme of things. So number one is higher consumer prices. Again, the same vein, those increased costs for businesses, it's going to hurt their profit margins. Again, they're forced to pass some of those costs to consumers. And again, a combination of higher costs plus reduced consumer spending is slower GDP growth. We've already seen that sort of factored in. Q1 GDP is projected to be in the -2 to 3% range, which is not a good start to the year, to say the least. At the same time, again, market volatility is something that is just not good across the board. Uncertainty creates volatility. You're going to start seeing companies report their Q1 earnings. You've already seen it a little bit this past week. And in those earning calls, when they're talking about projected earnings throughout the year, you're going to hear a lot about uncertainty as far as, well, it's hard to project our earnings because we don't know what the tariff situation looks like. We don't yet know how tariffs are going to affect our earnings. And ultimately, stocks are priced based on the future growth of a company. So if you can't project what that growth is going to be, that makes it really hard to project what a company should be worth. And that's why you've seen a lot of ebbs and flows in the market and this investor uncertainty relating to what companies are ultimately valued at. And then ultimately, again, the strained diplomatic relationships, what this means long-term with relationships with other countries, and maybe become harder to cooperate on security or climate issues down the road. And then the global supply chain. Anytime you have supply chain disruptions, things like that, again, that's not good from an economic standpoint across the board. So that's why markets don't like tariffs. Again, there could be some winners across the board, companies that are not reliant on outside countries to produce goods. Some domestic companies could potentially be winners in this space, but that sort of remains to be seen.
Yeah, I mean, think about the companies. There's companies around us every day, plumbing companies, tailors, dry cleaner. Think about all the local people that work in your community. They're not really, the tariffs aren't really impacting them. It's the companies that are the global companies that are shipping goods. It's the Apples, it's the Nvidias of the world, and any other global company you can think of that ships their stuff, and it derives a portion of their sales from overseas, and or are importing goods. It could be a restaurant if they do a lot of their ingredients, a lot of the things that they use are coming from overseas. Well, those restaurants are going to see a higher cost to operate for them. So therefore, you're either going to see those companies will make less money, or they're going to pass that cost on to us as the consumers. So the bottom line with this section is really just there's a whole lot of uncertainty right now. The tariff policies change. I mean, there for a while, they were changing by the hour. So what the actual tariff policies are going to be changing all the time. And then the retaliatory nature of those tariffs, what the other companies come back with. Our cards are essentially on the table. That happened on April 2nd. Now it's up. Now we're negotiating. This 90-day pause is to negotiate with all of the countries that we want to strike new deals with. They might say, you know what, we don't want to negotiate with you. Or they may not negotiate and come as far as we want them to come, and the tariffs might go back into place. So there's going to be a lot more rhetoric, a lot more headlines that you can expect to see move the markets. So if we just kind of project out and say, how could things get better? Well, here's a couple things you could hear that do happen. And the Federal Reserve, they cut interest rates that could stimulate, be a positive for the markets and for the economy. Tax cuts. So there is a reconciliation bill in Congress right now where they're looking at trying to pass some of the tax cuts that were announced during the campaign. If those tax cuts do get passed this year, that could be something the markets perceive as a positive. We see the negotiations. We had positive negotiations with trade deals with the different countries. And then you could see members of Congress really would have to come from the Republican side of Congress who would step in and say, we're not going to approve the tax bill unless you back off the tariffs. So all of these kind of cross currents are happening right now. And at any point in time, we could get news flow for the better that could cause markets to rebound. Could also get worse. As I mentioned, if those retaliatory tariffs, if we just get into a full-out trade war, if it escalates with just China alone, the second largest economy, that's a big deal. But it could also escalate with other countries during this 90-day negotiation period. If the administration digs in again, if they're not getting the negotiations they want, they could just continue to put their foot on the gas and just come out with higher tariff rates. Businesses, because of all this uncertainty, they don't know what their revenues are going to be. They have trouble projecting their own financials going forward. So therefore, you could see a lot of businesses kind of pull back from hiring. Let's talk more locally, what we've seen with Doge. Doge has had an immediate impact on those in the DC, Maryland, Virginia area in particular, because such a big part of our economy is supported by the government and government expenses. So if you, your spouse, or somebody is worried about their job because of Doge-related layoffs or just spending cuts, that's a negative. And then foreign investors, they could just get pissed off with us. Stop pushing us around with these tariffs. We're gonna stop investing as much money in the U.S. markets as we have been, and that could pull some money out of the stock market, pull money out of the bond market, and that would be a negative for U.S. stocks and U.S. bonds. We don't know where we're going to go from here. That's kind of there's a wide range of outcomes due to all the uncertainty right now. So let's wrap up with this this uncertain environment and some of the things that, just looking at it maybe a little historically and how you might want to think about it for your own portfolios. And again, we're going to wrap up with some resources we have. So Mike, you just kind of walk us through historically some of the things we've seen in markets in the past.
Yeah, so again, we got very, very close to what's considered a bear market in this latest market cycle. Again, before the reciprocal tariffs were pulled back for 90 days, the S&P reached a drawdown of over 19%. Again, a standard bear market by definition is 20%. We've actually seen 4 20% downturns in this millennium, dating back to 2000, both in the 2000 tech bubble, the 2008 financial crisis, COVID, and then during the inflationary period we had in 2022. So while bear markets are certainly a nervous thing to experience, they're not necessarily uncommon. They started actually happening a little bit more regularly in this millennium.
Yeah, so if you've been investing for a little while, you might have experienced this before. So draw back on that.
And this is probably one of our favorite slides because it shows that, again, volatility in the markets moving up and down is sort of what makes a market. We always say that, volatility is the price of admission. Over long periods of time, the S&P 500 returns, very, very strong levels, anywhere between, 8 to 10% a year over long periods of time. But to get those excess returns, it's not going to be a calm, smooth ride. Going back to 1980, on average, in a given year, you'll see the market drop about 14% intra-year at some points. So again, the 19% drop we just experienced is not too far outside sort of a normal market cycle. That those market movements, happen over time. But despite those movements, even though you have a 14% average downturn, about 75% of the time, the S&P 500 still finish up in the calendar year. take 2020 was the most recent example of this, where, believe it or not, the year of COVID, we saw a 34% downturn in 6 weeks, and the market still finished up in the calendar year. So we're certainly not projecting that this year is going to end positively, but the idea is that it's the importance of keeping your money invested, staying the course, having a plan in place. Those dollars that are longer term in nature, you should be less concerned about what happens over the next 3-6 months, but more concerned about what happens over the next 5, 10, 15 years. And that's why when Chris shows the life cycle funds, things like that, that's why those funds are so important. The longer time horizon you have the ability to experience these sort of market volatilities because you have time to let those recover. So what we see here ultimately is something that we would not call abnormal, but it's certainly nerve-wracking to say the least.
That's right. These red dots never feel good, but they happen regularly. And if you can think about this chart and just remember that 75% of the time, 8 years out of 10 calendar years, the market historically finishes up. So it's just important to remember that some of these charts when you see that. This is a really busy chart that I always hesitate. I usually don't put in here, and I hesitate to put it in. But what this is doing, this is going back to 2010, the third column here. And each of these colored boxes represents a different type of investment. So looking at 2010 REITs, that would be real estate investment trust or publicly traded real estate. You can see REITs for, really five out of the first 6 years to start the 2010s were the top performing asset class. Then they started to fall in order. And that's really common with, if you look year in and year out, what you'll see is that it's very rare that the top performing asset class, the top performing type of investment repeats to be the top performer year over year. That's why it's important we talk about diversification, and that's what those target date funds do. They create this diversification for you that can help kind of stem the flow. So if you look at these, just the first two columns, really the first column on the left, this shows you what those in cumulative, each of those asset classes has done between 2010 and 2024. So as you can see, during that 14-year period, large cap US stocks were the top performer. They on average returned 14% per year. It was a really, really, really strong last several years, I'll say decade plus, for large US stocks. If you were in all bonds or cash, you would have ended up with, if you were just in safe stuff, you would end up with a 1 or 2% average return per year. And you would have missed out on a higher return. Now, you might not have liked all this volatility, because in 2022, you might not have wanted to see your large caps drop 18%. Or where they are, so far year to date, this was down 7% through April 14th. So maybe you didn't like all that volatility. Well, if you were in an asset allocation, that's the gray bar here, you can see, you weren't the top performer in asset allocation, but you got a 7% average annual rate of return. And this next column is just a measure of volatility. How much fluctuation was there on that ride to those returns? And as you can see, the diversified portfolio, this asset allocation portfolio of about 60% stocks, 40% bonds, it was the fourth lowest from a risk volatility up and down standpoint, and it got the fourth highest return. So if you stay diversified, you were never at the bottom. You might not have never been at the top, but you were also never at the bottom. And that's what diversification does. It just smooths out the ride for you to hopefully make it a more comfortable journey, to keep you a little bit more kind of convicted in your investment strategy. And then just to wrap up here, again, just kind of harking back to, again, talking about diversification and maybe what happens within your target date funds. The green bar here just shows you historically the range of returns over a 1-year period for the S&P 500 or US stocks. Wide range of returns. There's been a 1-year period where they've done as well as 52% up. Everybody loves that. But there's also been a 1-year period where they go down 37%. So, and that's problematic. So if being totally in stocks is uncomfortable for you, you can start to introduce more bonds, as we talked about. Bonds historically have a tighter range as far as the variance of returns, up as much as 33% in 1 year, never a down 1 year period worse than 13%. We actually experienced that in 2022. So as you project out and you look at these time periods though, what you start to see, and this is the reason why the target date funds have a higher allocation to stocks for those who are further away from retirement. There's never been a 20-year period where the S&P 500 US stocks has averaged less than 6% per year over a 20-year period. And in the best 20-year period, it averaged 18% per year. Again, a bond portfolio, same, didn't get the same upside though. That's why there's more allocated to stocks. And then the bar on the far right here, I'm colorblind, so I won't even try to call it a color and embarrass myself. You know, you can see what it did. It did somewhere in the middle. And that's why, you know, depending on your risk tolerance, if you can tolerate these big swings up and down, then maybe being fully invested in stocks is appropriate for you, especially if you have a long time horizon. But if you're not comfortable with the fluctuations, that's where you need to start to introduce more of the conservative pieces, which is historically fixed income or bonds. And creating the right mixture for yourself is important. And again, we know that a lot of people don't have an expertise in this, and that's why, you know, the target date funds are made available in your 401k. So please, questions, comments, don't hesitate. I know people have questions on their mind. Now is the time. It's a stressful period. I chose to take time out of spring break vacation with the family because I wanted to be on this call with everybody because I know just it's been a really volatile last month or two. And I know there's a lot on people's minds. So please use questions or chat box if we haven't gotten to anything. And just as we wrap up here, I want to remind you that we have some tools and resources that are available to help you review. Let's just talk about the bottom one here. You know, if you're uncomfortable with the investments or not sure if you're invested the right way, you can use that QR code there. What that QR code will do is it'll take you to a risk tolerance questionnaire. It's a questionnaire that will get your appetite for risk. How much risk are you comfortable taking before you feel uncomfortable and start to question whether you're invested appropriately? What we can do is if you take that risk questionnaire, what we can do is we can compare what your personal, you'll get a risk score here, a score 0 to 100. And that'll be 0 being, you know, you don't like any risk, and 100 meaning you like a whole lot of risk. So you'll get a score for yourself somewhere in between 0 and 100. What we can do for you is we can then look at how you're invested, and we'll create a score for your current investment strategy that you have in your 401k. We'll send you a report so you can compare to see if your current portfolio matches up with your personal risk preference. So that's the risk score. And again, you can use the QR code here. There's also a handout where I believe it has the QR code on it as well. Feel free to email us, reach out, give us a call, and we can set up a time to walk you through this as well. And then, as always, I'll plug the personal financial website that we will create for you. This is something specifically for you, so it's not through your company. It's something we'll set up for you. And then you can use it to track your own bigger picture financial situation. You can use it to organize your different accounts so you can see in one place, you can see what your total kind of net worth is based on all of your savings, investments, you know, maybe real estate that you have, minus any mortgages or student loans or credit card or any other liabilities you have. So this is a great way to track your net worth. You can also run calculators on there to see if you're on track for retirement, if you're on track for maybe saving for kids' college, if that's one of your goals. So this personal financial website is another great tool that I encourage people to use, especially during times of stress, because it really anchors you back to what is the purpose of all this savings and investing that you're doing? What is the purpose of it? And how does it look in your big picture? Now, I realize these tools, they're meant to help you, but we want to give you guidance too. So feel free to connect with us You give us a call, shoot us an email. We'll set up a time to talk one-on-one with you, where we can review these tools with you. We can review the output of your risk score if you go through and do that calculation. We want to engage with you, and we want you to utilize our tools as best you can to help yourself. So thanks for joining us. Looking out over the next few months, next month, May 15th, 11:30 again, we're going to talk about college savings. For a lot of people, you know, if you have younger children and you're thinking about how to pay for college, we'll talk about how to plan for the expense of college, not only through its savings and investments, but we'll talk about some of the loan and grant programs and how to access some of those loan and grant programs as well. In June, we'll talk about the housing market and just talk about how, if you're a potential home buyer, potential home seller, how that might fit into your overall financial picture. And then in July, it'll be the end of a quarter again. So we'll take a look back at the investment markets through the first half of 2025, and we'll be ready to comment on anything that's kind of timely and happening in the markets at that point. Micah, anything to add?
Nope. No, that's nothing else out on my side.
I know we ran a little bit over, so I want to thank everybody again for joining. I don't see any questions or comments here, so you know, please, again, if you do have them, just email us and we'll get back to you. Set up a time and we'll talk one-on-one. So thank you to everybody. If you're on spring break, enjoy your spring break. Happy holidays, and we'll see you again next month.
Take care.